But we are going to take it to the next step. So I'm going to talk about building and managing. Remember I said earlier in the earlier talk, it's become one word for me, build and manage. The prior talk was really just, for folks who may not be sure of how to go find the proper stocks, right? Whatever your investment style is, that's how you use the VectorVest program. I showed you how to find good quality, prudent/conservative stocks. That's how you use the Unisearch tool to find whatever your objective is, as long as you know what that objective is. So I'm going to talk now about how to build and manage a retirement portfolio. And when it comes to managing a portfolio, I find it important to share with you a story of one of the greatest portfolio managers I've ever met. I know some of you have heard this before, but I don't care. I'm going to tell it again. The greatest money manager I've ever met over my long career in this field. I was back up in Connecticut, where I'm from. And with some old buddies, when I'd gone to visit, we went up to the casino, the Indian casino up in Connecticut. And we were just having some guys' night out. And as we're walking into the casino, Foxwoods it was, as I'm walking into the casino, there's a guy kind of behind one of the big pillars, and he kind of comes out and he goes, "Psst, hey buddy, can you come here a minute?" I'm like, what? What's going on, right? But I was with some old cop buddies, so I wasn't really nervous. I'm just like, okay, yeah, what's going on? So I go over to him, and he comes up and he says, "Listen, can you do me a big favor? Can you lend me $100? I said, "Lend you $100? I'm walking in a casino." He says, no, you don't understand. He goes, my wife is not feeling well. I have to go to the pharmacy and pick up her medication. Can you lend me $100? So I looked at him and I said, how do I know if I give you $100 that instead of buying your wife's medicine that you're not going to walk in there and gamble away the $100 I give you? And he looks at me very serious and he says, no, don't worry. I've got gambling money. The greatest money manager ever. He knew how to allocate. I got gambling money. Anyway, let's talk about how to build and manage a retirement portfolio. Every time I laugh, some people in here have heard that 20 times now. We still laugh. All right. How do I keep from running out of money in retirement? This is a question a long time ago. I remember we had come back from a seminar and had a meeting with Dr. DeLito, and I told him in some way, shape, or form, this is kind of the question as we build in our educational aspect of this, that I get, right, or that we had gotten back then. How do I keep from running out of money in retirement? And I phrased that question to Dr. D in the way only he could do, is he looked at me and he said, "James, just tell him to keep making more money." Right? So it's funny at first, but it really is, it's the answer, right? So how do we do that? How do we keep generating income in retirement, and how do we continue to grow our portfolio? That's what I'm going to talk about now. Now, I tell some old, what I hope are somewhat funny jokes, but there's no real joke about what I'm about to talk about, right? We're going to look at three core aspects, three core principles for how you at least should consider building and managing your assets in the equity markets towards your retirement. Now that's key. I was just talking to someone earlier. The allocation, right? You should have money in cash. There are certain, perhaps bonds or bond funds you should be in, especially where interest rates were in our T-bills, things like that. When I talk about allocating these strategies or these plans, I'm talking about the money that you invest into the equity side of your retirement portfolio management. Right? The old number is usually like 60-40, right? 60% into the markets, 40% cash and bonds. It's a good place to start. I know there's always articles about, is that the right number or whatever? You'll decide what you're comfortable with. But just so you know, when I talk about this, understand that there should be cash, there should be some other safer alternative investments. I'm talking about the money that you allocate to the equity markets, just to be clear. Okay? So how do we keep making more money by doing that? Well, let's talk about it and we'll set it up, right? You can retire with a peace of mind knowing that you can steadily grow your portfolio, generate income, and most importantly, as I said earlier, preserve your capital. Okay? You want to be able to preserve your capital. To me, that's number one, as I said earlier. Okay? But you're going to allocate, and depending where you are in retirement, as I said earlier, you're going to decide, am I going into the growth portfolio? Am I going ruler stocks, or am I going blue chip dividend payers? Just as an example. Okay? The answer is you should probably do both. But what you allocate to there is going to depend, and everybody in here has a different size portfolio, a different objective or goal. So I'm trying to lay the foundation for you to consider as you begin or continue or change your plans or whatever you want to call it to build and manage your portfolio. Okay, those are the goals. Those are the three core principles. We believe that a secure retirement is one in which you have enough income to live the life you desire, where work is optional and retirement is affordable. I know you see the commercials, buying the wine vineyard or traveling around, sailing around the world, whatever it might be. Whatever it is you want to do, right? For me, it's a cold beer after a round of golf, sitting on the front porch. That's my retirement someday, right? Still try to do that on the weekends at least, but during the week I don't do that. So it's whatever you're looking to do, and you have to keep that in mind. So what do you need to do to be able to achieve that secure retirement? Well, part of that peace of mind, there's just a little chart here to try to understand. Usually these scroll in, but we talk about the VectorVest 3 Ps of retirement investing, right? Again, these are the core principles. We talk about profit. When you hear us talk about profit, that is capital appreciation, a growth portfolio, ruler stocks, or whatever other search you might want to use for growth stocks, right? I want to grow my portfolio. I want to make money in the stock market. I don't want to lose it, but I want to grow it. That is the P in the three Ps that we talk about. Next is provide. When I talk about providing income, what do I mean? I talk about the dividend portfolio dedicated to generating a safe, steady income in your retirement investing. Now, we know that on the profit side, we want you to go from that roller coaster ride to the steady climb. Nothing goes straight up. We know that. There's always going to be drawdowns, but we're going to talk about how to help mitigate those. When it comes to provide, listen, you may have a handful of stocks that maybe have a small dividend, whatever. Maybe you're not even focusing on that. We don't want that income to just trickle in randomly. We want you to be able to put together a portfolio that allows you that safe, steady income. And then part two of providing, if you choose to, is selling covered calls to generate income, right? It's an option trade. We're going to talk about preserving capital as well. Go from being unprepared and not knowing what to do, not knowing how to protect your unrealized gains, to being prepared for whatever the market throws at you. Okay? That also requires an option trade. Now, I'm going to ask real quick for the folks who are in the room, how many folks in here, let me ask it this way. How many folks in here have never traded an option? Never traded an option. Okay, so looks like the majority have traded. So for those who haven't, okay, here's my take on this. I believe it is imperative that if you're here and your goal is to build and manage your retirement portfolio, you have to understand just two option trades. You have to understand the ability to sell covered calls and the power behind that. And what we'll talk about is called protective puts, how to buy a put option to protect. Ron Wheeler, as Ray said earlier today, there's no better instructor or expert on option trading. And he's going to come up here tomorrow and talk about that and show you just how great it is. My goal here is 2 option trades, and I'm not trying to turn you into an option trader. That's not my purpose up here. I want you to be able to protect your portfolio. Part of that is understanding how to sell covered calls and understanding the idea of insurance on your portfolio. Keep it very basic. There's a large list of trades and things you can do using the versatility and flexibility of options is endless, which Ron will talk about tomorrow. I'm talking about very specifically as an insurance policy and as a way to generate income. So that's the preserve, to me, the most important core principle that we're going to talk about. Any questions? Everybody good with that? Understand the foundation of what I'm trying to do? Because listen, I can spend 2 hours on one topic. I do an entire day on these 3 or 4 key core principles, the 3 core principles. But I'm going to lay a foundation for each one for you now. Profit. Capital appreciation comes from owning companies with consistent and predictable financial performance. I don't care if you're getting tired of hearing that phrase. I don't care. My goal is to beat it into your head. Capital appreciation comes from owning companies with consistent and predictable financial performance from a retirement-minded investor's point of view. There you go. How many New York Met fans up here besides Jerry? Not one New York Met fan here? Wow. Wow, that hurts. I know somebody there is if Jay is in the room, I know he loves it. Anyway, the reason I put this up here, this happens to be the 1969 Mets, the Miracle Mets. I remember going to some games that year. That's how old I am. They won the World Series. Why do I put that picture up? It's to focus on what Dr. D wrote and talked about often. Good portfolio management starts with buying the right stocks. It starts there. And I use the sports analogy. You could pick whatever you want. You got to put the best team on the field, on the court, on the ice, whatever it is, right? When you have the best roster out there, the best players, you're going to win. And it's the same idea. It's the same concept I want you to have when it comes to building your stock portfolio. Not one Met fan in here. Tom Seaver fan? Nobody like Tom Seaver? Come on, guys. That hurts. Anyway, so to do that, we talked about safety. And I mentioned earlier, and here's the slide I wanted to use, the stock safety, kind of the checklist that we talked about. These are factors, not all of them, but some of the factors that Dr. D put into the formula that gives us relative safety. Again, found in the little green book, as we call it, Stock Strategies and Common Sense, which you can all download. And for those who aren't sure how, I'll show you in the program before I'm done here today. Earnings consistency. Does the company make money quarter over quarter, year over year? Pretty basic, right? The company size, I talked about that earlier. Price behavior. Dr. D used business longevity. He phrased it in the little green book, better the devil you know than the devil you don't, right? Just because the company has been around for a long time doesn't mean it's safer, but it's one of the factors that go in. Dividend history, as I said, good quality. Safe stocks don't have to pay a dividend, but if they do, they better keep paying it. And then that debt to equity ratio. Does the company have the ability to withstand any headwinds that it might run into? So that's an important part of it as well. So all of those facts, so when I talk about relative safety, I just want you to know it's not just where does it come from or what number it is. All of these things go into it, among others. Already said, did I use the phrase consistent and predictable yet? Have I said that? Here's a picture of what we're talking about. I just, for your purposes within the book there on the slide, this is Cadence Design. I just used this from a couple of weeks ago. And I just wanted to show an example. Down below here, I didn't highlight it. This is the earnings per share. And this is obviously the movement of the price of the stock. And that goes back, I think it's a 5-year graph. I think that says 5 years, I believe, maybe more. But that's the movement. When we talk about quality stocks, a high RS of 1.46, a comfort index of 1.66, this is the picture, right? This is the picture I want you to look at when we talk about these type of stocks. So that's just one example of many, but that's what we're looking for. Dr. D talked about as the missing link, he called it in Stock Strategy and Common Sense. He said intelligent investment decisions cannot be made without including a knowledge of stock safety. Do not let stock safety be your missing link. Okay. Now, if we can go back into the program, Ron, I think I showed this. I just want to show again, when we talk about growth. I used ruler stocks as our model portfolio. That's one of the reasons why when we went through the searches, I showed you how to create a watch list and how to cherry pick if you choose to do that. But in this just automated model portfolio, just using ruler stocks, again, 148%, it's around 22%, as I said earlier. And again, that doesn't account for any mitigation techniques, which I'll talk a little bit about before we're done today. Okay? So that's the growth portfolio, the ability to grow that as one core principle. Now, the key of what I'm talking about here, again, is allocation. How you allocate it is up to you. We use, I don't have the pie chart slide up here, but theoretically, if you had $100,000 that you were allocating, right, the general look that I put up here is, right, 30,000 into a dividend portfolio, 30,000 into a growth portfolio, 30,000 allocated to buying stocks and selling covered calls, the buy right, and then 10% in cash. Okay, that doesn't include the percentage you put into cash, bonds, and alternative investments. It's just a theoretical number. The further you are into retirement, I would say don't go 30-30 on growth in income, right? Go maybe 40-20. You don't want the risk of growth the deeper you are into portfolio. It's a pretty basic premise that I'm sure you guys all know. But that's what we look at when we talk about allocating. And again, this is the type of performance we've seen. It's hard to manage a conservative folder in the bear market we saw that began in November of 2021. That's when it began, and it ran, for a while, right? I called it a bear market. Some people would question that, but it certainly was a bear market. So we did see the drawdown, and I explained earlier why that particular drawdown is there. In the real world, I would have not bought stocks on the day that the market was down several hundred points. But that's what we talk about when we talk about the growth portfolio. That specifically uses ruler stocks. In our coaching group, our retirement coaching group, we talk about selling covered calls. We show the ideal times to go in and buy protective puts. I keep it simple. I use the SPY. If I see a reason to protect or insure my portfolio, and I'll get into that in a minute, that's what we do. But that's how we mitigate those drawdowns. Okay. When we talk about the three core principles, that's the first core principle: growing your portfolio, knowing when to buy, finding the value of the quality stocks, and understanding how to protect them and grow them. Okay. All right, Ron, we can go back into the slides, and we'll go to the next slide. We'll shift gears a little bit, and we'll talk about building the income portfolio. Call it part one for steady income flow. We use both dividends and covered calls. So in the dividend portfolio, I talked about blue chip dividend payers earlier and what we do there. Dr. D also in Stock Strategies and Common Sense said the best of all worlds, right? Collecting dividend checks while prices of your stocks go up comes from finding solid growth stocks that pay dividends. VectorVest is ideally suited to find these babies. And yes, he wrote just the way he talked. It's ideally suited to find these babies. So that's what we're talking about. I just want to talk a little deeper about the dividends and how we rank and analyze dividends in the VectorVest program. So we look at, obviously, again, for your slides and for your information, a dividend is a distribution of a portion of a company's earnings to its shareholders. Right? They pay their shareholders for owning the stock. The dividend yield is simply the amount a company pays relative to its share price, and the dividend yield is that dividend per share divided by the price per share. Those are industry standard numbers. I'm sure you guys all know what they are. Right? The dividend and the dividend yield. Now, when we go into the VectorVest analysis of dividend, we look at the dividend, annual dividend paid, again, that's just the dividend. The dividend yield, these are industry standard, but then we come down to dividend safety, dividend growth, and the vector within the VectorVest program called YSG, yield, safety, and growth vector. So it's the VST of dividend. So I want to talk a little bit about I mentioned earlier, dividend safety on a 0 to 99 scale. Dividend growth is extremely important when picking your stocks. And again, indicator of the assurance that regular cash dividends will be declared and paid at current or higher rates, right? The higher that safety number is, the better it is. Anything above 50 we say is favorable. Stocks with high DS values have shown consistently strong financial performance, including that solid cash flow, that free cash flow. Very important. The more mature companies, that's why a lot of the ones I choose don't have that high RS. High RS stocks that pay a dividend are wonderful. You get capital appreciation, you get dividend payouts. Okay? What you don't get is the higher yield, right? The high RS stocks usually have the lower yield. So that's why we kind of mix them up there. Dividend growth is the forecasted annual growth rate of a company's dividend. Now we do it a little different, right? So we use it based on historical payments and dividend predictability using formulas within the VectorVest program. It's suitable, a subtle rather, yet important indicator of a company's financial performance. If a company is able to continue to pay and raise their dividend, Dr. D always said it provides insight into the board's outlook and the company's ability to increase those earnings, right? So there are a lot of strategies, a lot of ways to trade dividend stocks. Again, I said earlier, you have your monthly dividends, you have REITs, you have MLPs, all kinds of things. What I focus on is that ability to get both quality dividend payers as well as quality stocks where you do get capital appreciation as well. And finally, we take those yield, safety, growth numbers, and on a 0 to 2 scale, we simply give it that YSG vector. So we want to favor stocks that have a YSG greater than 1. Right? We take dividend yield, safety, and growth and put them into that single value. And it allows you, just like with a stock, the direct comparison of dividend stocks within the database. Okay. So that's an important number for us as we move forward. Ron, we could jump into the program. Again, I know I went into it earlier, but just to go into the blue chip dividend portfolio and just share that with you. This one's a bit older. I'll go back into ruler stocks too. So I talked about finding the right stocks earlier. The difference between simply finding the right stocks and having the proper management plan is really going to be the key to your success. So Ron, if you scroll over from blue chip dividend payers, so just to talk about how we manage this portfolio, you can go to we'll go all the way over. Where's the stop? There it is. I wanted to show the stop criteria. So what do we use? Every VectorVest subscriber has access to the profit locker stop criteria. So I use a 100% target and a 15% stop on the profit locker. So the 100% target, what does that mean? It's just a way of saying just allow the stock to run. We're going to let it go. I don't have it, if it's up 30%, I'm not going to sell it. I'm going to hold on to it. And again, what's my objective? I bought these stocks because I want a safe, steady dividend payout, right? So I use the 100% target and then the 15% stop, which is, again, the VectorVest proprietary stop. It's like a trailing stop. Ron, if we scroll back over, just to give an example, we can go all the way. We have the top stock. Go ahead and hit Profit Locker Pro graph, just to show you what it looks like. So we bought the stock back here. This is a PSX, I think. And you can see as the stock rises, without going into all the factors into the Profit Locker Pro, but the moving average moves up, stock begins to move sideways, it locks, right? It's a profit locker here. So right now the stock's trading at 134.90. The stop is down at 99.60. So we'll continue to hold that stock using that Profit Locker Pro. That is the risk management technique we use. The other thing to do here on this stock, this is a perfect example. At the end of the year, or even right now, Ron, if we go back to the sheet, I'm getting ahead of myself a little bit because I haven't talked about covered calls yet. But this is the perfect example of managing your portfolio, right? That was a pretty wide stop. With the MTI up around 1.68, and Steve talked about the overbought condition when the MTI is up in that area. We have a nice unrealized gain on the stock right now, right? We bought it at, it's not huge, but we bought it at 99.60. It's trading at, actually pretty good. It's trading at, we'll call it 135. Right? That's an unrealized gain. It's incumbent upon you to protect your unrealized gains. So what could you do? Well, with the MTI where it is, the perfect play on a stock like this is to go out and sell a covered call against that, right? The best time to sell covered calls is when the MTI is where it is now. And it's the perfect timing in the real world to show that. Ron, let's go to a market timing graph real quick. I know Steve showed this already, and I just want to comment because it's so great that usually I can go back 25 years and show the overbought and the oversold conditions and how the reversion to the mean plays its part. But the beauty is this year, I don't have to go back 20 years. Make it look like my EKG when I'm sitting on a trade or something, right? I could do that, but it gets confusing. The beauty of this year has been it shows you right here in the last year. We hit a peak. The MTI hit around 1.6, whatever the exact number was on that date. Doesn't matter, but we know it was in an overbought condition. It's time to be proactive. Do something. 25 years of history tells me that when the MTI gets above 1.6, that I need to start thinking about protecting my unrealized gains. Would it have helped? Selling covered calls, buying puts, doing something. Heck, sell the stock if you haven't owned it for 20 years and don't want to hold it for 20 more. That's up to you. My point is do something, right? Right here, it hit it again, right at the peak. What happened? The market came in again. I won't get into the oversold condition here, but once we got back in, it hit here again. End of the year, all the hedge funds, mutual funds, holding through the end of the year. Some of them sold off on the last trading day of the year. But I tried to get across the idea that come the first trading day of 2024, there was going to be some profit taking. Right? Everybody talks about the October to December run, and a lot of people forget the August to October time frame. Right? We can't talk about one without remembering the other, right? So there are ways for you to be protective, ways for you to protect and preserve without, again, for anybody who wants to raise their hand and say, well, couldn't you just sold your stocks? The answer is, of course you can. Right? Of course you could. Hopefully I'm giving you some alternatives. Anyway, that's the power of knowing when to be defensive, when to do that, when to sell the covered calls. And I just love that this 1 year without having to go back 20 years to show it. We could, I'm not going to do it, but if Ron dragged that all the way over, you'd see the same thing. And by the way, it could stay up there too, by the way. Just because it hits 1.6 doesn't mean it can't go up, right? An overbought market can still go up. The same way an oversold market can still crash and go down. Okay, we understand that, but Jerry already talked about recognizing that with market timing. I'm sorry, Steve, I guess Steve did, or both of them. All right, so we can go ahead and close out of here for now, and we'll go back into talking about providing income. So that's the risk management technique that goes with the dividend portfolio. So it's more than just going into blue chip dividend payers or pale blue chips and finding the quality stocks. You have to understand how to manage it. We don't put tight stops. It's not a trading account. 10 years plus on that account. And I'm telling you, I think there's maybe 50 trades over 10 years. And that usually comes when they get sold out, and certainly in the last year and a half, 2 years, they get stopped out, and then when we get the confirmed up, we use the confirmed up to get in. We buy 10 stocks. If they get stopped out, we go back in. That's 50 trades, 18% return. It's part two. It's just another way to allocate for that safe, steady income. Ron, let's go back in real quick. I want to talk about ruler stocks because I failed to mention the investment plan for ruler stock. So if we scroll over here, I'm back in the ruler stock portfolio. Yeah, we'll go all the way. I just want to show the stop criteria that we use. Okay, we use the 50 target, the 15 stop, just like the Profit Locker. Now this is different. Profit Locker Pro has some other factors to it that I'm not really going to go into now. We have a greed factor, we have an end trail. But the core of this is a Profit Locker Pro. These are default settings, and you can go in here and adjust the greed level. You can adjust the end trail. In other words, so if I have a 50% profit target, and I were to come in and change my end trail to say 5%, why would I do that? Right? Why would I do that? Because I own a stock that's rising in price. What the Profit Locker Pro does for you is once it hits that 50%, the Profit Locker Pro knows to go in and now change. From that level, it now has a 5% stop. Why do we do that? So that if the stock really does continue to run, remember, this is the growth portfolio. If the stock continues to run, goes parabolic, then you can continue to make more than the 50%. The default is the 1%, and I leave it there because I'm pretty happy when I can capture 50% gain in the growth portfolio. So I just wanted to share that because, again, this is all about managing the portfolio, not just finding the stocks. Okay? All right. And these two, you can sell covered calls against and you can buy protective puts. And we'll talk about that. Ron, we'll go back into the slides quick. So far we've talked about two of those core principles: growing your portfolio with the proper growth stocks, which I showed in the first talk, how to find those. Again, I use ruler stock. If you've been with us a while, you may have other searches. You may have created your own searches. Just be sure that they're good quality, safe, high RS stocks, however you come across them. Right? It's the management part that's going to hurt or help you. Right? Now, what we do is, when we talk about income, we call it part 2. And this is where I want to spend a few minutes talking about selling covered calls. Now, there are several reasons why anyone building and managing a retirement portfolio should understand and sell covered calls against their positions. Number one, which I won't get too far into today, is against stocks that you already own. I already showed, right, that PSX, the Phillips 66. I'm long 200 shares. I have a nice unrealized gain. I have an MTI up around 1.6 I think is the hit. I can sell the stock, yes, I know. I could sell covered calls. I get paid, right? And I'm going to walk through that in a minute. Well, let's just do it. Sell covered calls to generate income. Anybody do that now? Does anybody sell covered calls? And what I'm going to focus on here in the talk is buy rights. In other words, buying the stock, simultaneously selling the covered call with the objective. The objective is income generation. Now, if I already own a stock like PSX and I sell covered calls, my rationale, I mean, it's the same function, but my rationale is more defensive. I'm going to lower my cost basis. If the stock pulls back a bit, I have at least a cushion. Now, if the stock really crashes, it's not going to help all that much, in which case we can place a collar trade, which I'll talk about too. Okay. So let's talk about selling covered calls. This is a quote from a gentleman named Lee Lowell, a book that he wrote called Get Rich with Options. I did over the years have an opportunity to chat with Mr. Lowell a couple times. I took this out of his book. Dr. DeLito read the book, forwarded it to all of us in education, and because he did that, we all read it. I thought, and to this day, simply the best definition of what a covered call is, whether you're experienced at it or whether you're brand new to what the heck is a covered call. It's the most logical, understandable definition I've seen. If you own 100 shares, you got to own at least 100 shares to sell a call against it. And you're not selling call options, you're throwing away money. And highlighted here is the definition. There are traders out there who will give you money today for the right to take your stock away at a higher price at a later date. That's all a covered call is for those who are new to it. Somebody's going to pay you money to take your stock away at a higher price. Okay? He goes on to say, it's such a great strategy for padding your account. I still can't believe investors aren't taking advantage of it, and frankly, neither can I. They're going to pay you to take your stock away. For those who might be new, I have just a quick illustration on a XYZ stock here. Let's just say you buy the stock, or maybe you own it already, but we'll do the buy right. You buy the stock at $60 a share. I then go ahead and sell a call option against it. 45 days to expiration, I go out and sell someone the right to take away my XYZ stock at $62.50. And they paid me $2 per share to do that. That makes my cost basis for this position $58 a share. I got $2 in, I own it at 60, they paid me $2, so it's 58. Now, these are just kind of what ifs. This is just a general kind of what if situation. In our process that we use in our coaching group, we don't hold them to expiration. Sometimes it could happen, but generally we don't. We have a risk management process for that as well. At expiration, though, if XYZ is above 62.50, what happens? It gets called away. You are assigned. You wake up Monday morning. If it expires, in other words, called in the money, if it expires at 62.51 where the stock price is, you wake up and you don't own 100 shares of XYZ anymore. You were assigned, they take your stock away. Okay? That's a good thing, right? That's our objective. That's our goal. People will say, well, one of the negatives of this is what if XYZ opens Monday at $75? Jim, you idiot, you just cost me $15 in capital appreciation. And I'm telling you, I don't care if the stock goes to $460. Why is that? Can anybody tell me why that is? Right. One reason is because you made a profit. And you made the profit that you were planning, that was your objective before you hit the enter button. That's why I don't care if the stock goes to 200. Your objective, your rationale for doing the trade was to generate at least a portion of that, $4.50, which is a 7.5% return in roughly a month, a little over a month in this case. Remember, I'm not talking about growth. Ron will teach you tomorrow how to trade options for better profits. This goes for any type of trading or investing you do. Know why you're hitting the enter button. I knew going in, that's another beauty of the covered call, of the buy right, I know exactly what I can make. Right? Theoretically, I can lose, in this case, I could lose, my max loss is $58 a share, or $5,800. That's if the stock goes to zero. We're not going to allow that to happen. Okay? Your objective is to generate in retirement a safe, steady income. I would love it if the stock opened at 80 on that Friday morning. I just leave it, take my stock away. Now, once you start doing this, and if you're trading these, are there techniques to trade around that? Of course there are. I know that, but it's not what I'm talking about here. Now, what if XYZ is below 62.50 at expiration? What if it's below there? Well, I'm still long the 100 shares at a cost basis of, another margin call? This is the time the margin calls come. Yeah, the witching hour, 3 o'clock. If XYZ is below 62.50, we have a cost base of 58. In this particular example, it builds in a 3% cushion. Right? Doesn't sound like much. If the stock crashes, it helps, but you own it at 58. So the stock could actually move sideways or go down a bit, and you can still make money. You're going to hear that phrase tomorrow when Ron talks about selling credit spreads. Right? That's one of the beauties of selling covered calls. Now, what if XYZ is below 58 at expiration? Well, that's when the losses will occur. Right? Because you own a stock that's now trading below its cost basis. But you're not adding any risk by selling the covered call. I was telling a gentleman during the break, I took my Series 7 in 92. The only trade you could do in an IRA account, the only option trade back then was a covered call. And the reason is because it added absolutely no risk to your position. The risk is inherent in the fact that you own the underlying stock. So of course, our process and technique will have stop criteria for you to get out, at a reasonable loss. The process will show that. Okay, but that's the anatomy of a covered call. Those are what happens. Generally, in the process we use in our coaching group, we very rarely will hold these. Sometimes we roll them. There's things you can do, but the idea here is to generate that steady income. I can tell you, 2023, most of it, 2022 was a tough time to sell covered calls against individual companies. We didn't do a lot of, I went a lot of times without even doing them on a weekly basis because of the market. This year in the coaching group, I'm going to start doing more specific industries and sectors and try to do one each week. XLE, the energy ETF, is one I did this week in the coaching group. But this is just the anatomy of what the covered call looks like. Okay. Again, I believe imperative for you if you're looking to generate income and manage your own portfolio. We have some buy right guidelines. Again, they're guidelines. 5% return on investment if called away. That's the guideline. So using that example I showed, I think it said 4.75% was the return. Oh, no, I'm wrong. It was 7.5%. So that would fall under this guideline, right? Premium received. In other words, I'm talking about setting up the trade. How do I know? Very basic criteria here. Again, I'm not trying, my job, other than the jump starter course, is not to turn you into an options expert. That's what this guy does, Ron. So I want you to receive a premium of at least 2% of the stock, underlying stock. Okay, that's just a basic guideline. The expiration, the window we use is an industry standard 30 to 45 days. We need some liquidity in the underlying stock, at least 100 contracts. And then for our purposes in retirement, we're never going to hold a covered call or a buy right through an earnings report. It's just not worth the risk. Okay. So those are some of the guidelines that we use for the buy right. 2022 especially, a lot of 2023 was difficult. 20 and 21, we were doing trades every week, and we had 20, 23, 24% returns on these. But in all honesty, we're not as, in a bear market like that, it's a lot more difficult. Okay. Plus, I do it in a live account in Thinkorswim in a VectorVest account. So I'm extremely prudent with the VectorVest money. Yes, sir?
In a retirement account, what are your considerations, if any, for tax consequences?
Okay, so the question was, what are my considerations for tax consequences? And I'm going to take the easy way out on that. Right? VectorVest and me, I'll speak for myself, I'm not a tax specialist, right? My quote for that, my answer to that is if you're paying taxes, it's because you made money. So I don't have a real straightforward answer, other than if you're doing them in an IRA, you don't have to worry about it, right? But
would you typically do covered calls on stocks you've already held for more than a year?
Yeah.
Or that's a buy right strategy, so you're buying them down.
Yeah. Yeah, so the question is, would I sell them against stocks I've owned for more than a year? That could be a requirement, right? Because now it's capital gains and not ordinary income that you're being taxed at. So that could be a consideration for you. I don't know that I would not sell a covered call. A couple of things. Ray, I don't know, how much time do I have? Where's Ray? Do I have time?
Yeah, you can do whatever you want.
Okay. It's a great question, right?
You got it.
Now I forget what the answer was going to be. So when you're selling I know what the answer is. So when you're selling covered calls, right, the fact is that it's really pretty rare to actually have your stock called away or be assigned. It's really pretty rare. Even if your stock goes deep in the money, it's going to get called away for a couple of, is it possible? Without a doubt. But here's the thing. When I did a buy right to generate income, that's what I want to happen. I want them to call it away. If I'm selling it, to your scenario, against a stock I already own, and I really don't want my stock called away. You have two choices. Don't sell covered call against it, which is one. The other choice is to sell them deeper out of the money so that the stock has to move further, or keep a much closer look on it, keep an eye on it. You could always buy back the call at any time. You'll lose a few bucks on the call option because the call option rose as the underlying stock rose. But of course, that's offset by the fact that the underlying stock is running. And then you call what's called rolling it out, right? You just sell another higher strike call. That's a way of managing that call. So the two answers are, if you don't want to lose a stock, either don't sell covered calls against it. I don't really recommend, I think you can. Sell them out of the money, a little deeper out of the money. When you own the stock, that 5% yield or the 2% premium, That rule really isn't if you already own the stock. Okay? You can generate income on stocks you own and build a cushion, lower your cost basis, and you could take a little less than that. So there really are two different scenarios. It's a great question. I don't mean to sidestep the tax question, but I kind of do. So that's it. Anyway, in the books, I just showed this as an example. I just wanted to illustrate what it looks like. This is from our Options Pro software, kind of a back test, if you will. This is Rambus. This position, if you had used, again, using a DEW timing system, any market timing system that tells you it's okay to get into a bullish trade. By the way, buy rights are bullish trades, right? If I'm buying a stock, it's a bullish trade. I'm selling a call against it. My hope is still that the stock goes up, but I do have protection on the way down. So in this particular case, I just used the DEW. We bought in this 200 shares of Rambus, which was a top stock in a bunch of searches at this time. This was back in November. We used the 30 to 45 days. This was a December expiration with the stock trading at 56.55. We sold a December 60 call option, right? A December 60, which gives me the ability to capture capital appreciation as well as the premium that I received. In this particular case, if you held it all the way out to expiration, you would have made, I guess I got blocked out there, I think just about $2,000, a little more, if you held it to expiration. Our risk management techniques do not have you doing that, right? In fact, we just tighten the stops for both loss and profit target gains. But you would have been out somewhere right around here, okay? So we would have opened that using our process. We would have closed that position at an aggregate price of $58.81 using our process, right? The cost basis for buying the stock and selling the call was $54.05. I controlled 200 shares and I sold the two call options and I took in $500, went into my account. So as we saw in the next slide, what happened just about not even 3 weeks later, using our process, you'd be out of the trade at an aggregate price, buying back the call, selling the stock, $58.81. That's just under a 9%, it's about 8.8% return in less than 3 weeks. That's the ideal trade. Does that happen every time I do a buy rate? Absolutely not. Okay, I'm just showing it to show it to you. But when you follow a process, you follow a plan, you're able to generate that safe, steady income. Let me finish here with the most important part, because I'm afraid I'm losing time here. Preserve, protective puts. To me, the most important core principle of building and managing your portfolio is understanding insurance. You insure your home, your life, your car, your health. And I always joke, but it's going to make me cry, is that my wife and I have insurance policies on our dogs, although I just lost my very best friend about a month and a half ago. One of our dogs, we put it down after 14 years. But that's what you do, right? So why wouldn't you understand an insurance policy to protect your net worth? Again, I'm not talking about trading options for profit in an up or down market. That's not the way I'm looking at it right now. Okay? I'm talking about ensuring your retirement net worth. And I've used this quote forever from Mark Twain, my fellow Connecticut Yankee. Don't just sit there and worry, be proactive, do something, anything about what's worrying you. Okay? I've suffered a great many catastrophes in my life. Most of them never happened. I just love that quote when it comes to this first line. Don't just sit there and worry that your stocks might go down. Okay? Be proactive. Do something, anything. So when we talk about protective puts, we talk about put options. I'm buying put options to protect either an individual stock or my entire portfolio. Because I don't have time to go into a lot of the deeper points here, I brought up an example of just protecting the portfolio overall. Now you could do this on individual stocks. Right? You can sell a covered call against ABC stock that you own. You can take the premium you receive and you could buy a protective put option with that money. Right? So it's a lower cost insurance policy. I wish I had another half hour to talk about collar trades. Now, buying the put options to protect individual stocks, we're going to talk about the overall portfolio. Here's a quick case study that we actually used, two of them actually, that we did use in our retirement coaching group. Okay. For those who aren't familiar with options, what is a put option? If I buy a put option, I have the right to sell a stock at a certain price by a certain date. If I buy a put option, it means I'm bearish on that underlying stock or ETF, right? If the underlying asset falls, the value of my put option rises. That's just a quick 2 sentences for those who may be new to options. Okay, an insurance policy. You have an asset that's damaged, you get paid, hopefully from your insurance company, to help offset those damages. On 7/20 of last year in the coaching group, we bought 3. I use SPY, the ETF that tracks the S&P 500. I also use the Qs. Sometimes I use IWM. In my own personal accounts, I use IWM for a lot of things. But SPY, the S&P 500 ETF, right? I own stocks. I'm invested, of course, and I know somebody will type it in the chat box back there, or they'll ask. Yes, you can just sell your stocks. However, you can understand the power of a protective put. We went out and we bought 3 of them. We bought an August 54 put option. This was back on 7/20 at $5.37 or a price of $1,600 for 3 contracts. Okay. The idea here is that if the S&P 500 falls, the stocks in my portfolio will be protected. Maybe not dollar for dollar, but it will mitigate the drawdown. It will mitigate the losses. Okay. In this case, it was a little bit early to do it. The market moved up, but it did fall, and we were able to, and this was an actual trade in the coaching group, we bought them at $5.37. We actually sold them a few weeks later at $9 for $2,700. I think it was actually I wrote it down here. It's like a 67% gain in about 3 weeks on that insurance policy. I had an asset, my portfolio, it was damaged, and my insurance policy helped to offset the damages. Does that make sense to everybody? Just an insurance policy. Does that make sense to everybody? Well, even that was bad. Wow, okay. Yes?
I have a question. In that example, what triggered you to sell it? And the reason I'm asking is because, say, right now, I have protected puts out there.
Mm-hmm.
The market's been, like that.
Yep.
So, you don't want to get rid of your insurance.
That's right.
And it continues to go down when you think it's going up.
That's right. So the question is, how do I manage that trade? When do I sell it? The short answer is I use a 50% stop on the option, which sounds like a lot, but remember, it's a $5 position. I use a 50% stop. Now, I might close it earlier than that if I feel like the market's stopped falling or is not going to fall. 50% stop. If it goes up, the value of my put options go up. I use kind of a window between 50 and 100% profit to reevaluate the market, okay? Certainly at 100% profit, which is what my next example reached, I'm going to close the trade. I'm going to pocket the profit, and I'm going to reevaluate and ask myself, do I need more insurance on this policy? Okay, and real quick, that's what the second one in your books did. September 19th, we bought them 2 more contracts, 552. In this one, it was literally 3 days later, and I closed it for 100% profit. And then, listen, it would have gone higher, but I don't care. We got to manage these trades. I don't have VectorVest end of next day yet. You guys know we're working. Linda left that out when Linda talked this morning. She talked about some new things we're doing. I mean, I'm not supposed to talk about it. Ray's going to get mad at me. There's VectorVest end of next day coming, and we're working on that. But
I have a question.
Yes, sir.
I read some time ago that most options expire, or 60% of options expire. Is that still true?
Yeah, the question was the old saying that, actually it's like 90% of all options expire worthless. Ron probably will talk about that tomorrow. It's really kind of misleading, and Ron, correct me if I'm wrong. They don't expire worthless. Usually, hopefully, they're sold back to the market maker, and there's still trading going on within them. But for the average individual investor, that may be true. If you allow an option to expire worthless, unless you were short that option, you're not trading it right. right? You don't have a process or a technique in place. But yes, generally speaking, it's true, but there are a lot of more factors.